Okay, great. I think the numbers have stabilized. So let's make a start. We've got about an hour-long webinar today talking about UK tax and what you need to consider when you're moving to the UK. So please feel free to put questions in the chat box. We'll try and pick them up as we go along. If not, we'll pick them up at the end. And if we run out of time, we'll make sure we answer them after the event, but we'll try and do them today. So moving straight on. What we are going to talk about today, I'm going to do some introductions, talk about some basics, what we mean by residence, what we mean by dual tax residence and double tax treaties. I'm going to touch on the non-dom tax changes, quite a hot topic at the moment, and then talk about remote working in the UK and some things that we'd like people to be particularly careful about. So, introductions. My name is Alex Coghill. I head up our international private client team. I've been working in international tax since 2009. So I do a lot of international stuff, but also have a specialist interest in property taxes.
And hi everybody, I'm Bridie Chesa, and I'm also part of our private client tax team and part of the international tax team as well. So I started at Larkin Gowan in 2017 in our medical team initially, then moving into personal taxes, specialising in offshore and pensions, so on. So let's go to the first slide, everybody. It's the basics and what do we mean by residence. So residence for tax purposes is very different to what you would normally assume residence is. So it is not a simple case of where you consider yourself to be living, where your main or only home is, where you work, where you were born, or where you're a national citizen. That is not what we look at when we consider whether or not someone is a tax resident. So when considering this, we look at how many midnights somebody spends in the UK and the reason why you're in or outside the UK, and what your future intentions are and what your past circumstances were as a whole lot. So it's a little more nuanced than that.
And the reason it's important and why we're starting off with tax residence is because UK residents are typically taxed on worldwide income and gains, whereas non-residents are typically taxed on only UK source income and gains. And I say typically because that might be about to change, and I will come on to that later.
Lovely, thanks, Alex. So when we look at residence, we look at a bit of legislation called RDR3, and that is known as the statutory residence test, and it consists of 3 automatic tests that make you a UK resident, 3 automatic tests that make you an overseas resident, and if you don't hit any of those automatic tests, we then look at sufficient ties. So sufficient ties is we assess how many connections you have to the UK. Prescriptively, they're accommodation tie, which is if you have a home available to you for 90 days and you stay in it for 1 night, you have an accommodation tie to the UK. 90 days, if you spent more than 90 days in the previous 1 or both the previous 2 tax years, work in the UK for more than 40 days in a tax year, and you have a spouse, civil partner or dependent children in the UK, these are all things that would be considered a tie. Now, if you look at the table matrix we have on the slide, you'll see the more ties you have to the UK, the less days you have to spend here in order to be considered a UK resident. So, because we're talking about coming to the UK, we're going to look at the automatic tests in a bit more detail. So the first test is, have you spent more than 183 days in the UK during the tax year? If you have, you're a UK resident. Failing that, we look at the second test. Now, this is where there is a period of 91 consecutive days, of which 30 have to fall into the tax year, where you have a UK home where you spend a sufficient amount of time, 30 days, and you have no overseas home in that period, or you have an overseas home but you do not spend more than the permitted amount of time there, which again is 30 days. Failing both those tests, we look at the third automatic UK test, which is working in the UK. And this is where you work full-time in the UK for any period of 365 days, with no significant breaks, and you work more than 35 hours a week on average, and more than 75% of those working days in that 365-day period are UK work days, and at least one of those days in the 365-day period is in the relevant tax year.
Thanks, Bridie. I would just like to flag, so that all sounds quite complicated. Don't worry, we're quite used to working through this with people. But what I'd like to flag is that under that second automatic UK test, you can be UK resident by only spending 30 days in the UK. So 30 days when you've got a UK home and no overseas home. And in theory, under the third UK test, you can be UK resident by spending 1 day here if you've moved here to work full-time for a 365-day period. In practice, you're never going to be UK resident with just 1 day, but you know, in theory, you don't need a huge number of days to become UK resident somewhere.
Thank you, Alex. So when you automatically fit into one of those tests, so say you are automatically overseas, automatically UK resident, or UK resident under the sufficient ties or non-resident, we can also look to split the year. So this treatment will apply in a year where your pattern of presence changes. So someone entering the UK, for example, after a full year of non-residence. Splitting the year is where you identify the relevant period of entry to the UK and apply non-resident treatment to the part of the tax year, one part of the tax year, and UK resident treatment to the other. So you literally split it for tax purposes. And whether or not you can split a tax year is absolutely a question of facts. There are 8 cases where an individual can be eligible to split year treatment. 3 of them relate to exiting the UK, and 5 of them relate to entering the UK. So if you were entering the UK and wanted to use split year treatment, the cases that would apply would be starting to have a home in the UK only and ceasing to have an overseas home, starting full-time work in the UK, ceasing full-time work overseas, and accompanying a spouse and starting to have a home in the UK.
Thank you. And again, my little sort of addendum to that is that you can split the tax year on a date that is not the date you physically fly into the UK. So you could end up splitting the tax year earlier or later than your flight date. Okay. So I'm going to talk you through dual residence and double taxation treaties. So we've talked about residence and the fact that you could be UK resident here with just a small number of days. It is perfectly possible to be dual resident in 2 countries at the same time. When this arises, then we need to look at the double taxation treaty to decide which country you're going to be treaty resident in. So basically, one country trumps the other, and you're treated as a tax resident in that country and treated as a non-tax resident in the other country. There's a series of tiebreaker tests which determine it. They're pretty much the same for every country. First of all, you look at where is your permanent home, and if you only have a permanent home in one country, that's it. You stop there, you don't look any further. If you've got a permanent home in 2 countries or in neither country, then you look to where your central vital interest is. I like to describe this as your life, where your friends, your family, your bank accounts, your pets, your car insurance, where is your life? If that doesn't give a clear answer, you then look at habitual abode. That is where you normally live. And finally, if none of those give a clear answer, you look at nationality. But I mean, I've never really seen anyone go beyond centre of vital interest. Normally those point clearly to one or the other.
And I'll just make a point there, Alex. So whilst, yes, you can be resident in 2 countries or 1 country, you can also find yourself resident in no countries in a tax year if you find yourself to be quite nomadic. So if you don't fall into any of the domestic rules of those territories and become resident in those territories by spending too little time in multiple places, you can also find yourself resident nowhere.
Yeah, I'd agree, but I haven't seen it that often. I do think it is quite rare. So the circumstances I've seen it is when somebody has left the UK at the end of the UK tax year and then they've gone travelling for a few months and then become resident in a foreign country at the start of their next tax year. So it's generally a small window of opportunity, but if you can do it, great, because that could be some really good tax planning. So here we go, we've got just a couple more examples to talk about that dual residency. Mr. A moved from the UK to Australia on 1st of December to take up full-time employment. He only spent a handful of days in the UK prior to that. He's going to be a UK resident from the 1st of December. We'll split the year. That's quite a simple case. Mrs. B, on the other hand, again, this happens, we see this, you know, she's retired and spends 6 months of the year in the UK and 6 months in Cyprus. So she has a permanent home in both countries and she's tax resident in both countries under their domestic rules. And so in that scenario, that's when we look at the double tax treaty tiebreaker tests. We've already said permanent home in both locations, so let's look at the centre of vital interest and see whether it's closer to the UK or Cyprus. Dr. C is an international commuter, so he lives in France with his family and he works 4 days a week in the UK and 1 day in France. Again, he has a home in both countries and he's tax resident in both countries, and therefore we need to look at those tiebreaker tests to decide where his centre of vital interest is. For Dr. C, I would say the presence of his family in France and the fact that probably France is where he's living and he's just commuting to the UK for work and then going back to France for everything else, that would probably be a bit clearer that France is the treaty country there, as opposed to Mrs. B, where it's a bit more even. Okay.
Right, so we'll quickly touch on double taxation treaties, as this is quite techy. So, but just bringing to your attention that most countries worldwide will have an agreed double taxation treaty with the UK. And it provides a comprehensive breakdown of the most common types of income sources and how these are treated between the two countries to eliminate double taxation. So these situations occur when a resident of one territory holds assets or receives income from another territory. The treaty will dictate who has the right to tax the income, whether or not the individual is entitled to a tax credit, if any, and to eliminate double taxation, and confirms any limitations and kind of acts as a mediator. And where there is no taxation treaty between the UK and the country in question, for example, Brazil doesn't have an agreed treaty with the UK, a non-UK resident will continue to be taxed on their UK arising income and some gains, and a UK resident will continue to be taxed on their worldwide income and be entitled to a credit. Now, one thing I'll bring up about double taxation treaties that's quite a common thing that we see, for example, is pensions, private pensions, not government pensions, they have their own separate thing, but private pensions are usually taxed only in the country where an individual is resident. So say somebody moved to France and had a UK pension, France would actually have the taxing rights on that pension and not the UK. So that's where the double taxation treaties are very important to review and check every time. So let's have a look at an example here. So we have Ash. He is a UK resident and a higher rate taxpayer with various types of income, including some dividends he holds in a Swiss company, Canto SA. Switzerland deducts withholding tax from the gross dividend at 35%, and Ash receives the net. But because he's a higher rate taxpayer in the UK, the dividend is taxed at 33.75%. So you would think the foreign tax credit from Switzerland would cover the tax in the UK in full, but unfortunately not. The UK-Switzerland double taxation treaty actually states that the credit claimed in the UK cannot exceed more than 15% of the gross dividend paid. So the 20% difference is just lost in the UK. Instead, you'd have to go back to the Swiss authorities and apply for a refund of taxes overpaid over there. So it's a bit of a faff.
Yeah, Switzerland is one we see quite a lot, isn't it, Bridie? Because most countries are quite good at applying a withholding tax of 15%, which is typically the treaty rate, not in every country, but typically. Switzerland is one that's just mean, it just applies a 35% withholding, so you have to go through that refund process. Okay, I am going to try and give you a lowdown on the non-dom tax changes. So this is a really hot topic right now, of course, with the election coming up. First of all, I thought let's have a bit of a poll and see, well, do you know, do you consider yourself to be a non-dom or not, or do you just not know?
Give people a little bit longer just to answer. Fantastic. So we've got a majority percentage at 67% saying no, and actually 22% saying yes, with 11% saying don't know. So Alex, did you want to sort of explain?
Great. Yeah, absolutely. Okay, so domicile is a difficult concept to explain. It's actually a legal concept, not a tax concept. In some countries, it just means the place you live, but in the UK, it means your lifelong permanent home. It rarely changes unless you make a permanent move to leave one country and settle indefinitely in another country for the rest of your life. It dates back from colonial times, when people would travel out to the colonies and would very much want to be considered British. But in this internationally mobile day and age, it is rather outdated. So it probably is time for some changes. Right. So these changes here are what have already been announced, and they were announced in March by a Conservative government. We are expecting a Labour to broadly follow the Conservative manifesto rules. So there will be some changes which I'll highlight, but what I'm saying here, it's not law yet. It is proposals. It could change, but I think it's unlikely to be scrapped. So what we're expecting from 6th of April 2025, we're expecting the non-dom regime in its current format to be abolished. And instead, what will happen is that new arrivals coming to the UK will benefit from a 100% tax relief on their foreign income and gains. This is what we call the FIG regime, foreign income and gains, FIG. So the FIG regime will apply for the first 4 years of you being UK tax resident, for somebody that has been non-UK resident for the previous 10 years. It must be claimed, and if you make the claim, then you're going to lose the tax-free personal allowance and annual exemption. So for somebody who's only got a little bit of foreign income and gains, then it won't make sense for them to claim. They'll just choose the more beneficial route for them. And it will be available for people who wouldn't meet the criteria, but actually they came to the UK before 6th of April 2025. So it'll be available for their remaining 4 years, whatever they've got left. The important difference between the FIG regime and the non-dom remittance basis regime is that it is 100% tax relief, no matter what you do with the foreign income and gains. Under the old remittance basis regime, you had to keep that out of the UK for the rest of your life. So a non-dom could claim the remittance basis in their 20s and then remit the income to the UK in their 80s, and tax would be due on that income 60 years later. And that's an impossible period of time to monitor and get right. So the FIG regime will be much easier to get right, but it is for a much shorter period of time. So once you're into your 5th year, UK residents will have to pay tax on their worldwide income and gains, whereas previously it was up to 15 years. So there are some obvious losers from the changes. So non-doms who could have claimed the remittance basis for more than 4 years, they're the obvious losers because of that limited amount of time. Settlers of excluded property trusts are going to be hit hard. Currently, they are not taxed on income and gains arising within those trusts as long as it's protected and not tainted, but that is going to change. And under the Conservatives, they want to tax income and gains arising in the trust. Labour want to tax income gains and inheritance tax arising in those offshore trusts. So settlers of excluded property trusts are going to see the most significant changes. And then people who move partway through the year are going to lose out as well, I think, because the FIG regime is for 4 years only, and that's 4 tax years. If we talk about coming to the UK and splitting the tax year, let's say you split the tax year in February or March, well, that's still a tax year for the FIG regime. So you might only benefit from the exemption for 1 or 2 months versus somebody that is moving to the UK in April or May and will benefit from nearly a year. So in the most extreme example, you could have someone move to the UK, claim FIG regime, and they'll only get it for 2 years and 2 months rather than a full 4 years. However, I do actually think there's going to be some winners out of this new regime. And the number of non-DOMs is relatively small, but the number of people that move to the UK with foreign income is quite a lot larger. So the key winners, I think, are going to be those who are permanently moving to the UK, because if you remember what I said about domicile is changing your home and settling roots with a lifelong intention to stay in one country. So if you're moving to the UK and have no intention to leave again, you're UK domiciled from day one. You can't access the non-dom remittance basis. Whereas now, those people will be able to access the FIG regime for the first 4 years. Similarly, those people who have a UK domicile of origin, so that's born in the UK to a UK father, those people, if they've been absent from the UK for the last 10 years, when they return, they can benefit from the FIG regime for the first 4 years rather than being taxed on their worldwide income straight away. Those people who are staying for fewer than 4 years will benefit simply because the regime is going to be so much simpler and there's no requirement to keep the money offshore and have all these complicated segregated accounts between clean capital and income and gains. So it'll just be much easier for those people to manage. And then current non-DOMs who've got all this offshore income and gains but can't bring it to the UK because they're going to pay tax will be able to take advantage of a temporary repatriation facility where they'll pay tax at just 12% rather than 45%. So quite a significant bonus. That's got an asterisk next to it because I would warn you that Labour haven't committed to the 12% rate. They have just said that they will explore ways to encourage people to remit the income and gains. And then finally, last category of winners are people who've got quite a lot of unrealised gains. So they haven't sold an asset, the asset's standing at quite a high value, but they're looking at selling it in the future. Certain non-DOMs will be able to rebase that to the April 2019 value. Again, that one's got my health warning because Labour haven't commented on that at all. So we don't know whether that will or won't come in. Moving on to inheritance tax, we know a little bit about this, but actually much less has been published. We are expecting a consultation to move away from domicile-related inheritance tax to residence-related inheritance tax. So the suggestion that we've got that is supported by both the major parties is that people who've been UK tax resident for 10 years will be subject to IHT on their worldwide assets after that 10-year cutoff, and then there will also be a 10-year tail for people leaving the UK. So it is, I wish I had more information to give you at this point in time. There isn't much, but watch this space. So we'll be publishing more information as and when I find out about it, maybe as early as next week, but certainly in the coming months. So in terms of what I suggest people do now, my key advice actually is to wait because we think the rules will be subject to some change. It's unlikely they'll be reversed, but we do think there will be tweaks. And just take advice before moving to the UK. You'll get the most up-to-date information. If there are things that need to be done before you become UK tax resident, then it's better to know about it before that happens. We can't plan retrospectively. So yeah, just take advice would be my top tip.
Thanks, Alex. That is a big subject and a lot to digest. So yeah.
Thanks for bearing with me with that.
No, that was fantastic. So I'm going to take you through some remote working in the UK. Now we'll start with a poll. Mr. A fell in love last year and moved to the UK to live with his now fiance. He works in IT for a Spanish company who continues to pay him in euros and deducts Spanish taxes and social security. Mr. A is very conscientious and makes sure he files a Spanish tax return every year, but does he have any UK tax obligations? Let me know what you think. Let's give you all a couple more seconds. Oh, fantastic. We clearly have a lot of tax accountants in the room because we have 100% yes. So let's unpack this slide by slide. So remote working. Employees and self-employed people are taxed where they work and not where they're paid or where their employers are based. Top line. Someone who works in multiple countries for short periods of time is likely to qualify for treaty exemptions. However, employers may still have an obligation to report this even if no tax is due. If an overseas employer sends you to work in the UK, they will probably help you get your tax right, so always ask. But if you choose to work remotely in the UK yourself, they probably won't, and it will be down to you. More than just tax needs to be considered as well. We need to look at social security, payroll requirements, employment law, visas, lots of other things to consider.
I just got to interrupt here because Bridie knows remote working is a bit of a bugbear of mine, and I find it best explained with an example. So Bridie and I both do a similar role. We're both sitting here in the UK, but let's say I'm paid from Larkingowan, UK, and Bridie is paid from Larkingowan, Dubai, if we had that entity. Would it be fair that I would pay tax and social security on my earnings and she wouldn't? She'd pay nothing because Dubai is a tax-free country. Of course it wouldn't be fair. So that's why your tax position has to be based on where you physically are carrying out the duties, because otherwise it would just be too easy for every company in the world to set themselves up in Dubai, and then no tax would ever be paid.
I don't know, me getting paid tax-free sounds pretty fair. I'm okay with it. Right, so let's have a look at an example of this. So Bridget. Bridget is a research scientist employed in India by a small independent medical research company. And as a result of COVID, all of her work can now be done remotely via Teams and Zoom. So she decides to move to the UK for the weather. And her Indian employer has given her permission to work remotely, all but for 1 week a year, where she's asked to come back and attend the company's annual training update in India. Now, Bridget continues to be paid in Indian rupees by the Indian company, and their payroll, taxes, and take social security. They're all deducted monthly from her salary as they were before. And Bridget is a UK resident and therefore taxed on her salary in the UK. So no credit can be claimed for the Indian tax paid except for the 1 week where she actually worked in India. Instead, she'll need to seek a refund of Indian taxes to avoid double taxation on the rest of her salary, because as we've just discussed, she's performing her duties in the UK, she's being paid by an overseas employer, but her duties are in the UK, she's taxable in the UK on a proportion. So
great. Thanks, Bridie. I think that's really clear.
So let's just go to a few more details on that, just to build on it. So depending on the company's position, monthly PAYE may need to be deducted and paid to the UK tax authorities. Now, will India give the tax refund before the UK tax is due to be paid? Maybe not. And then we were looking at cash flow issues, so something to think about. As India is a non-agreement and non-EU country, the UK national insurance is payable after 52 weeks spent in the UK. Again, more things to think about. And if there is no UK entity, then Bridget may have to operate an employee NIC only scheme herself. So yeah, I mean, international social security is incredibly complex and depends on where you work, where you are coming from, for how long, and who your employer is. So social security is not like tax, which can be sorted out through filing an annual tax return, it needs to be considered in advance and an appropriate scheme set up. And I've heard tales of airport officials demanding to see social security papers before they will let people into the country to work. So yeah,
that's pretty scary. It's pretty scary that airport officials could stop you there, isn't it? But yeah, I guess just goes to show that it is more than tax.
Absolutely.
Great. So we wanted just to highlight two or three things that we think people should be particularly careful about. The first one is capital gains tax. So it's been pretty common tax planning that when somebody is coming to the UK, and they have offshore assets, is just to sell those assets before your first day of UK tax residence. That's because once you are UK tax resident, and you sell those assets, you're liable to CGT on the entire gain, even if you've owned that asset for the last 50 years and you're a non-UK resident for the last 50 years, apart from one day, you sell it on day 2, then you're still taxed on that entire gain. That is potentially going to change under the FIG regime, but for now, that's still good, generally good tax planning, depending on the country that you're coming from. Obviously, if you're coming from a country with a high CGT regime, then it's better to pay UK tax than, I don't know, German tax, for example. If you're coming from, go back to our example, Dubai, then clearly you would want to sell those assets whilst you're still tax resident in Dubai and not a UK tax resident. My note of caution on that is for temporary non-residents, for those who have been out of the UK for fewer than 5 years. That's a very specific anti-avoidance rule, whereby gains are then suddenly taxed in the year of return if you haven't spent a full 5 years out.
Lovely, thanks, Alex. So just circling back to our double taxation treaty slide, just wanted to touch on foreign pensions just as a sort of isolated bit, because the UK, for example, operates a tax-free, taxable process for pensions. So that means our pension contributions are tax-free when we put them in. The growth in our pension schemes are tax-free during its lifetime, but we only pay tax when we withdraw it, obviously subject to the 25% tax-free withdrawal lump sum. Whereas some countries like Australia, for example, operate a different scheme, which is taxable when it goes in, taxable throughout its lifetime on the growth, but tax-free withdrawal at the end of its lifetime when it crystallises. So moving from this system to a UK system will lose the tax-free withdrawal amount. So say I was an Australian resident, came to the UK and withdrew my pension, I'd have been taxed every which way. So that's a bit of tax planning that people would need to think about. Pension rights are typically granted to the country of residence, as we discussed before, and not the country where the pension arises. So, and one line of this, beware of lump sums. Just a little red flag in there. So we'll leave it at that.
Yeah, you'd think all pensions would have the same tax treatment, but we've already flagged government pensions are different, lump sums are different, state pensions are different. Yeah, we can help, absolutely, when it comes to all of these. So I reiterate, get advice, and there is no one size fits all rule, unfortunately. We just need to look at it on a case-by-case basis. Great, so there are a few particular foreign investments that cause me particular concerns when I see them. So the first one is personal portfolio bonds. These are a type of sort of offshore investment life insurance sort of policy, but they have particularly penal tax rates. So you can be taxed on 15% annually on the value of the fund, regardless of whether you're making any income or profit. And those are cumulative charges, and they can become ridiculous quite quickly. So personal portfolio bonds are just a big no-no for UK residents to hold. Offshore non-reporting funds, so these are mutual funds, hedge funds that don't have special reporting status with HMRC. the HMRC doesn't like them, so when you sell them, it says that any profit you make on those funds is going to be subject to income tax at rates up to 45% instead of capital gains tax at rates of up to 20%. You also can't deduct losses, so if you make a loss on that, you don't get to claim a 45% deduction. You end up just banking a capital loss that you can only use against future gains on other assets that are not offshore non-reporting funds. It is generally, the worst of both worlds to have those. And then finally, US citizens should just always take extra care because they are taxed on their worldwide income and gains in the US by virtue of their citizenship and in the UK by virtue of their residency. And there are special rules about which country is then allowed to take the foreign tax credit so you don't incur double taxation.
Lovely. So we've come to the end of our actual presentation slides, and we'd kind of like to open up the floor to you all to ask any particular questions you may have. We have had one come in during the presentation that I'd just like to float with you, Alex, as it was part of the new foreign income and gains regime.
Yeah.
And it was, if I've been resident in Portugal for a number of years and I come to the UK and benefit from the new FIG regime, does that mean that my pension is no longer taxable in the UK nor in Portugal if it were exempt under the treaty? Is that true? Can you be in a position where your pensions are completely tax-free?
Potentially. So I know this is an area that we do need to look into once we've got more of the rules, but what I would expect is that the default position is that a country can tax income arising in the country. So if we're Portugal here, you'd expect the default position to be that Portugal would tax pension income arising in Portugal. That's overridden by the tax treaty when somebody becomes UK resident. But what you'll probably find in the tax treaty is something that says that the pension income must be subject to tax in the UK before Portugal will give the exemption in Portugal. And that's probably what will happen. Not all tax treaties do have that subject to tax provision in, but so what I would expect to see is, right, so your first 4 years of UK tax residence, if you claim the FIG regime, you're not reporting your Portuguese income, therefore it remains taxable in Portugal instead. And once that FIG regime ends and the income is taxable in the UK, then it is no longer going to be taxed in Portugal and you can claim the treaty exemption. So it's just shifting things down the line, whereas that change would happen as soon as you came to the UK now, it would probably shift it down the line. That must have been an accountant who asked that question.
That's it. Although I've had another question come in in the interim, Alex, that I feel like an interrogator. So under the new regime, returning long-term US resident, UK citizen, they should consider returning after the 6th of April 2025. Is that a hard date or could residency start earlier?
So I would always say don't let the tax tail wag the dog. If you need to move because, I don't know, you're moving for elderly parents or you're moving jobs, then move. Don't let tax be the driver. But if you're going to move before 6th of April 25 and you've got a lot of foreign income and gains, then you are either going to have to claim the remittance basis in the 24-25 tax year, pay no UK tax on that, but then you need to keep that foreign income and gains outside the UK, or pay UK tax on that. Now, you're talking specifically about a US person here. So for a US person, they're probably going to pay US tax on that income and gains anyway. So keeping it outside of the UK tax net, is that going to benefit you that much because you're still going to have to pay US tax, or do you just pay UK tax and offset the US credits? You're going to have to pay tax somewhere on that because you are a US citizen. So US citizens, whether you claim a remittance basis or not, is very much subjective in terms of the amount of income you've got. But under the FIG regime, so let's say that comes in, so from 6th of April 2025, they'll be under the FIG regime. They'll have 3 more years remaining where they can just exclude from UK tax all of their foreign income and gains. Still going to pay US tax, but they can exclude it from the UK. And the only difference to claiming the remittance base for the early years is they can bring that to the UK and not have to worry about it. So there is no hard start date. You can, you come when you come, and depending on what regime is in force, those will be the rules. But I go back to my point about trying not to arrive in the UK sort of close to the end of the tax year. It would be better if you're thinking of coming, January, February, March, can you delay it till April? Because then you're going to benefit from much longer under the FIG regime.
And just as an aside, if you were a US just resident and not citizen, your obligations in the US would be different, I assume.
Or I would definitely be deferring to a US tax specialist on that, because whilst we can talk about how the UK and the US interact and who has the treaty rights on particular types of income and foreign tax credits, the one thing I'm prohibited doing, and I'm so sorry, is I cannot tell you what the US tax rules are and the requirements for that. So yeah, we work with lots of US tax advisors, both in the UK and the US, because it is such a complicated system that they have, like the UK. But that's what we're here to help with.
Lovely stuff. And one other point that's been raised is, are the slides available to download anywhere? Whilst we don't have them available to download here, we can send you a copy for your files.
Yeah. And I think our marketing team are going to follow up with everybody and send them a link, but it will also be on our website, and the slides will be on the website very shortly. So yeah, you'll definitely get those. Great. Okay, so I think that's us. If anyone wants to send any more questions through at a later date, we'll be happy to pick them up. Otherwise, thank you very much for attending. We really appreciate your time. And feel free to get in contact with myself and Bridie. You'll find our contact details on the website if you've got any further questions.
Thanks ever so much, everybody.